Adam, thanks for taking some time to join me on the podcast.
Thanks for the opportunity to chat to you.
Yeah, it's always good to chat markets, public markets. We're going to talk about a little bit about LIC structures, about what that means when you can access unique markets. We're going to talk about leverage in portfolios. We're going to talk about portfolio construction. But maybe to set the scene, just a little bit about yourself. I'd love to know, you've got a pretty fascinating background like in your professional career. So I'd love to know what led you here today.
I'll start by saying that I am probably older than I look. Well, I am older than I look, I'll say that. So I've sort of had two professional careers. I started off as an equity derivatives trader in banks, trading and structuring derivatives. And a lot of my thinking around risk and sort of my approach to markets was really formed during the period. I mean, I was trading when the dot-com bubble burst. I was sitting at my desk when planes flew into the World Trade Center, and I had to deal with the aftermath of, the whole 9/11 thing. I traded through the run-up, the exuberance into the global financial crisis, and obviously the after effects, the European debt crisis. And I think, they formulate the way I think about things. And then my second career started when I came to Pengana in 2013. Initially, my focus was on areas that were in my historical wheelhouse, hedging balance sheets and, doing structured products and things like that. But through time, my role has evolved. Today, I'm involved in strategy and new product development. I lead the distribution team. I look after the relationships with some of our fund manager partners. Yeah, I think that probably sums up the role today, which is pretty broad.
Yeah. Maybe it's true that you are, you're older than you look, but in a good way. That's always a good thing, right? So trading through those market conditions would have been somewhat harrowing, I imagine, at the time.
Well, look, it can be. I mean, the advantage of running big risk books is that you can structure them to take advantage of volatility, or to, you can be on the wrong side. And there are times when I've experienced both. Sometimes it was luck, and sometimes, I would say that there was an element of skill involved. But absolutely, you learn about the importance of managing the risk environment that you currently aren't expecting.
I read on the way over here, I did not know this, but I believe Pengana takes its name from an ancient bird that had some sort of special kind of skill set and a really unique kind of attribute that gave it a competitive advantage.
Yeah, so that's right. Apparently the Pengana had these ankles that could swivel 360 degrees, which enabled it to extract things from crevices. And the idea is that we can extract value from hard to reach places. So we kind of like that analogy.
Yeah, it's a fitting analogy for what we'll talk about today. Can you give us, speaking of, no pun intended, the bird's eye view of Pengana? We've spoken to many people over the years, and I actually recall that I think we had some blog posts shared on our platform 2017, 2018. So many of the Rask community would be familiar with Pengana, but from the highest level, what does the business look like?
So we're a very diversified and very experienced funds management business. We started in 2003, so we've been around a long time. I think there are a couple of key differentiators. We don't target the institutional market, so our target client base is sort of sub-institutional. We don't have a house view, so sometimes when you speak to other funds management businesses, they would say, oh, we're a value house, or we're a growth house, or whatever the case may be. Pengana doesn't have a house view, so each of our strategies is managed by an individual team that we believe has great investment philosophy and a great process to generate long-term returns regardless of the style, which means that we are very, very differentiated. We don't have Me Too products. And this is an advantage because when we go into meetings with our clients, we don't have to have the kind of conversations, show me your nail because I've got a hammer, that sort of conversation. We can have real conversations about the challenges they're facing, where there are gaps in the portfolio, and if any of our products can be included in the portfolio to generate better outcomes for their clients. Most recently, we've been focused on the illiquid space. So historically, our business has really been focused on listed markets, but more recently, we focused on the illiquid space. And the idea is to bring private market access to our sub-institutional client base, because historically private markets have been easier to access by institutional investors, the larger end of town. The investment sizes are enormous. There's very complicated sort of management of cash involved, etc. So what we have tried to do is we've tried to democratize that process and bring the advantages of private markets to our segment of the client base.
For people, let's start with absolute basics, Adam. So as we think about private versus public, just the highest level, what would you say is the prime advantages of private markets? If people are still in a listed mindset, so maybe they've got index funds, maybe they've got active funds that pursue, outperformance in various stock markets around the world, what would you say are the high-level benefits of private markets?
There are a number of benefits. They differ between private equity and private credit. They're in some way overlapping, but there are some key differences. Private markets have historically outperformed. They don't always outperform. We've been through a period recently when listed markets have outperformed private equity, and there'll be other periods when that happens, absolutely. But historically, private markets have outperformed. In the case of private equity, it is really because of control. It is also because when we think of active management in the listed equity space, your active share refers to how different you are from the benchmark. So your activity is really still buying and selling the stock or the company. Whereas in private equity land, the activity is really getting involved in professionalizing businesses, improving operations, refining product lines, that sort of thing. So there are so many opportunities for real improvement through active management. When we talk about private credit, what we're talking about here is we're talking about global private credit, and the sector that we target is the middle market. We like the middle market. Let me take you through the reasons why. When we're talking about global private credit to the middle market, we're talking about loans that have been individually negotiated between a private credit fund, a private credit provider, and a middle market business. In the US or Europe, that's $1 billion business.
So big business by Australian standards.
Big business by Australian standards, okay. These loans are secured either against cash flows or assets, and they have seniority, which means that there's not another lender that's going to get paid first. But the key difference is that in the private markets, these loans are held to maturity or potentially even beyond, because they're often refinanced. And that really matters, because when people think about incentives, if you are operating in the listed market, your incentive is to originate a loan and then sell it to somebody else who's going to carry that risk, who's going to be the ultimate holder of the loan. And so their incentive is to find a market clearing price, a price at which others want to buy that exposure. Whereas in private markets, because you are holding it for the full journey, you are incentivized to really understand the risks and price according to those risks, not just according to market conventions. You are then incentivized to ensure that the documentation is watertight, so that you have all the early access to information, you have the remedies when things could go wrong, and you really are incentivized to ensure that all steps of the process are fully covered. And that's why when we look at private credit loans and compare them to traded or syndicated loans to equivalent companies, historically, private credit loans have had lower rates of default, and when defaults occur, the recoveries have been higher. And so that's kind of the private-public sort of debate, which feels to me to be pretty well settled.
Yeah, I think it does too, for what it's worth. It's interesting, isn't it? Because the Australian marketplace and investors in the Australian marketplace, I would say historically have had very limited access to what's available here in this country, but in the US, it's very well established by comparison. Do you think that's a fair statement?
I think it's interesting because actually in the US, there's a difference between, their qualified investors and their non-qualified investors. And qualified investors can get exposure to a lot of the cool stuff that non-qualified investors can't. They do have, obviously, it's a much bigger market. There's a lot more product available. So there are opportunities for them to invest in private markets, but I'm not sure if on average, the smaller investors are really getting access to the best things.
I just know here in Australia that a lot of the people that I speak to, if they're looking for non-equity like, maybe with air quotes, they'll look to things like hybrid securities. And it's only really more recently that they've started to kind of open their eyes to what maybe actually is private credit as a viable kind of alternative to that. One thing that Pengana is known for, and we're just talking before we hit record, is the kind of unique structures. So LICs, LITs, funds, what have you. Maybe it's worth talking about the structure and how that plays a role in getting exposure to those markets, because as most people on this show would be familiar, you can't do that through some structures. So maybe that's worth talking about.
Absolutely. And I think that you're right. Pengana has thought very carefully about having the appropriate structures for the investments. I think that listed investment vehicles, whether they're trusts or companies, are the ideal investments or the ideal vehicles for holding long-term illiquid assets. It gives people the opportunity to get access to the good stuff without necessarily the trade-off of, okay, well, now I don't have any opportunities for liquidity. We're not saying that the long-term investments should now be considered short-term investments. What we are saying is that this gives investors the opportunity to get parcels of long-term investments in sizes that suit their risk portfolio construction, etc., with opportunities for liquidity when those are required. And I think that what you're going to increasingly see is more innovative approaches. So, for example, when we listed our private credit trust, which was listed after a long period when there'd been no new issuance coming to market, we realized that if the market was going to accept a new issue of a listed investment trust, we needed to embed something within the trust that would anchor the unit price to the NAV. And so we came up with an innovation which involved giving investors the opportunity to sell back their units on a quarterly basis to us at the NAV. That's worked very well. Actually, a lot of other issuers have started to use similar technology in their trusts because it has anchored the unit price to the underlying NAV.
There was a bit of news out recently, and I know there's a webinar coming up on this for the Pengana shareholders, but the Pengana International Equities LIC, or PIA, there's a conversation and there's an announcement that's been made about basically blending the international equities with private markets, and so private credit. This is a really interesting development because I guess when I was looking back, I couldn't really find any other instance where this might have happened, but also the way you've gone about it's really unique. So I might have some questions that fall out of this, but at the highest level, what was the kind of, I guess, key opportunity for you, and what was the solution to it?
So if we think about Pengana International Equities, PIA, as we refer to it, the objective of PIA has always been to provide Australian investors with an opportunity to diversify their equity exposure without undermining their ability to generate franking credits, okay, to earn franked dividends. And so basically, you alluded to hybrids, bank hybrids are disappearing. And it's at the wrong time, because it's at the time when Australian investors are, if anything, more income hungry as the population ages, etc. So what we've really done is we've taking cognizance of the environment, we've thought, how can we enhance PIA without deviating from its existing objective, which is the diversification with the franked dividends. And so what we've done is we have introduced a second income stream into the fund, into the company, which is funded by debt, but it's conservative. So only about a third of the assets will be debt funded into private credit.
Okay.
Now, private credit behaves differently to listed equity. And the combination, so the correlation, if we talk briefly about correlations, if you've got a correlation of 1, the assets will move in lockstep. If you've got a correlation of -1, the assets will move in opposite directions. The correlation between private credit and listed equity is reasonably low, which means that there is enough zagging of one asset class when the other asset class zigs. And so what that does is when you combine them into one portfolio, you get better risk-adjusted returns. So it's not like we're just we're using leverage to increase risk. We aren't doing that at all. We are acquiring, diversifying exposure. There's a concept, a Sharpe ratio, which measures return per unit of risk. And the combination of both should result in a better Sharpe ratio for our investors. The other point of diversification is on dividends. So if we think about the dividend profile of the ASX, more than half the dividends come from sort of banks and miners. If you add in energy and REITs, it's over 70% of dividends are from those 4 sectors. Now, if you think about the risks those sectors are exposed to, they're exposed to interest rate risk, housing risk, commodity price. It's not that many risks that they're exposed to. And so what we're trying to do is we're trying to diversify the dividend exposure as well by introducing dividends from an entirely different uncorrelated source.
You mentioned 1/3 of the portfolio.
Yeah.
So maybe for a nuts and bolts, think about this. Like if I was an investor looking at PIA, what is my yield expectations before versus after this change happens?
So at the moment, PIA pays a fully franked dividend of 5.4 cents a year. That's paid quarterly. Under our proposal, it will pay 8.4 cents. And because it's a more significant amount, it makes sense to pay that monthly now. So if you take the franking credits into account, this is now at the current NAV going to be an 8% fully franked distribution. We're trading at a bit of a discount at the moment, so that it is a higher yield at the current price.
When is this taking place?
So basically, we came up with an idea. We thought this is a really good idea. We think that it should resonate with our investors. Let's ask them. Yeah. And so it's going out to vote. The vote's on the 10th of October. And we would urge all investors to have their say. I mean, that's really what we want. We want investors to understand that we think this is great, but we value their opinion. We're not looking to make any changes without really understanding the preferences of our investors.
Yeah, for sure. That sounds pretty appealing to a lot of people. So effectively, you've got the combination of a growth asset with the credit to provide that stability of income. When it comes to the leveraged component, can you talk us through the economics of that? Because people are familiar with like geared funds or leveraged ETFs or something like that. And probably the two things that they think about are like what's the return and what's the cost of capital. So can you give us some context around that?
Sure. So what I'll do is I'll talk about it in hypothetical terms. It's a lot easier. So if we assume the cost of debt is 5%, let's say, we are we are targeting a rate of return on our private credit investments that's 4.5% above the cost of debt, okay? Pengana is completely aligned because we are not taking any income on that or anything. And what we will do is if the return on the private credit is insufficient to cover the cost of debt. So if I said the cost of debt is 5, if the private credit only returns 3, Pengana will chip in the other 2. So the change won't be to investors' disadvantage. So we've undertaken that. Pengana will participate beyond the target return. So, cost of debt being 5, target 4.5, over that, any returns above the 9.5 will go to Pengana. So when you add all of that into the portfolio, if we're achieving along the lines of our target expected return, you're looking at about a 2% uplift in the ongoing yield of the portfolio.
Right. Okay. And then there's franking credits could still pass through because it's a listed investment company, not like an ETF or something like that, and you can bottle that up and smooth the journey for people.
Absolutely. So the vehicle is key. We couldn't do this if we were offering it out of a daily liquid fund or an ETF or anything else like this, because you can't take the illiquidity and somehow make it liquid, particularly if you're relying on investors' behavior, because the behavior of investors always changes during periods of crises. That's something I've certainly learned. So because it is a closed-end structure, we can take that illiquidity and we can, generate the returns from that illiquidity. Because it is a listed invested company, it's got a very, very long track record. We've got a very healthy franking and profit reserve. So we can continue to pay franked dividends into the future. And because it's a company, the interest income that we earn can also be paid out as franked distributions. The other advantage of offering it out of a large listed trust or listed company, is the fact that because we've got the scale, we can get exposure to the best managers.
Yeah, that was going to be my next question. Is so just for people's understanding is so you've got this part of the portfolio that's reserved. There's a leverage element. Where does that capital get deployed? Like, what's the underlying fund or strategies that you're pursuing?
So that gets deployed into a very, very diversified portfolio of global private credit. Now, diversification is important in credit. And if you are an active manager, you say, I want to pick the best, 20 companies that are going to outperform. When you're a credit manager, diversification really matters because your best return is contractual. You're not going to do better than what it says on the document. But obviously, if you have idiosyncratic events, you have defaults, etc., you can do materially worse. So diversification is your friend. We have got, over 3,000 underlying loans. We've got 24 underlying funds, really, really high quality funds. This portfolio is curated by Mercer. So there's really 3 parties that are involved in, or under our proposal, there will be 3 parties that will be involved with PIA going forward. So there's the Mercer team. We only allocate to highly rated Mercer managers. Now, Mercer is one of the largest allocators to global private credit. Globally, they see everybody wants to be rated by Mercer. They've got very robust processes around operational due diligence, ensuring that these guys are good stewards of our investors' capital, investment due diligence, legal due diligence. So it's all covered with Mercer, and we only allocate to the really high regarded managers, from the Mercer universe. There's the Pengana team. The Pengana team has been carefully put together to ensure that we've got the right people in the right places. So our CEO is an executive from a non-bank lender. Our portfolio manager was a head of market risk and ran asset and liability management for banks. And our CIO is an actuary, so he's on top of all the modeling. And then, of course, there's the Harding-Loevner team, which we can speak about separately.
Yeah, sure. That would actually be good.
So, look, the Harding-Loevner managed the listed equity portfolio. This is an institutional manager out of the US. It's got amazing pedigree. The founders actually came out of the Rockefeller Foundation. So if you can imagine the approach that the Rockefeller Foundation would have to managing equities, it's about protecting and growing. It's not about, risk at all costs or anything else. And that really manifests. If you look at their long-term track record, and they've been going since 1989, their long-term track record on a rolling basis shows that they tend to outperform in sort of the average to weaker markets, and then they will probably leave something on the table when the markets are really going gangbusters. And that really resonates. You don't want to have an extremely volatile underlying when you are combining it with the leverage of the private credit.
Yeah, it's really interesting because I don't think I've seen this before. Maybe one final question is not necessarily on your portfolio construction, but just for investors listening to this or viewers watching it, is how do you envisage this being combined in a portfolio? And does it take the place of something else? Does it suit a particular type of investor? You think more like who would be in your mind when you think about this?
So that's a good question, and I think that the traditional rules of portfolio management have sort of fallen by the wayside. I mean, the idea of a 60-40 portfolio is less popular today than it once was, or certainly went through a period of when it was a little bit out of favor. I think that investors increasingly need yield, but they need capital growth as well. And so, it doesn't matter where you bucket it within your portfolio. I think that the diversification offered within the structure makes it broadly appealing to a lot of investors.
It's very interesting because with rates falling here in Australia, having fallen twice recently, people are now looking at what are their sources of income. We've seen a compression of yields on the ASX. The ASX 200's yielding 3.1% at the time of recording. Sure, you get a little bit of franking credits, but it's not what people were used to 10 years ago, right? So it's a very different environment that we're moving into. And so I'm also aware, and we've spoken about this on the show before, about people moving too far out the risk curve.
Yeah.
And that can mean into, if they're wholesale sophisticated investors, oftentimes they move into these lock-up funds at 3-5 years, lock-up terms sometimes. So, and they really don't have the sophistication, even though the laws might say they do. They don't have the sophistication to understand that, whereas this can provide effectively daily liquidity because you're on the market, right? Listed products. So that would definitely be my preference for people that are listening is, I say go through one-way doors slowly, because it's an old Jeff Bezos line, is that if you do something with your portfolio, how do you come back from that? And so having the ability to have the listed product, but also get exposure to those markets is really compelling for a lot of people, is what I would say.
Absolutely. And I think that the other thing is, talking about the income, this is diversified because a lot of people who are looking for alternate sources of income would be looking at Australian private credit. And Australian private credit, once again, what I said about the sources of franking income, largely, interest rates, housing, that sort of thing. The Australian private credit market is largely susceptible to the same risks. And so we are providing an alternative there as well.
Yeah, great. I'll put a link in the podcast player and show notes for people that want to learn more about PIA, about the upcoming proposal as well, and how people can hear more from you and the team. One question that I ask all guests on the show, is a final question that I ask, is just more like a philosophical one, if you could go back in time to a younger self. Now, you've had a pretty mixed and varied, and I imagine at times very exciting professional career. But if you could go back in time and tell yourself one thing about, say, investing, business, finance, what might it be?
One thing.
You can have more if you want.
Okay. My children will tell you I have many of these, much to their irritation. I guess I would tell myself not to take things so seriously. I could probably still give myself that advice today. I think it's very important to be long-term and not to get caught up in the noise. I mean, we all know about, that you can get sidetracked, but we all know about the benefits of long-term compounding and investments. But I think the same compounding applies to all aspects of our lives that are important, our relationships, our careers, the skills that we acquire. One of the things that I've started doing more recently, which I probably wish I'd started doing earlier, is writing things down and keeping a record. When I have a great day, I write a few lines. When I have a terrible day, I do the same. And I write on one side of the page and I keep the other side blank because it allows me to go back and revisit these things. And often what you find is like, the terrible days when you go back have either faded into insignificance or actually were great learning experiences. And the great days that you thought you were a genius are often attributable to luck. But what it does is it helps you to better understand your thinking. It gives you a good basis for decision making and keeps you rational when things might not be going as well as planned. So I think that's a good tip I'd give myself. You do actually have, that's wonderful advice. You do actually have the Pengana notebook there. And I did see you scribbling down some things beforehand. So that makes a lot of sense. It makes a lot of sense. Well, Adam, this has been heaps of fun, mate. I really do appreciate taking the time out of your day. And it's been lovely to meet you. So thanks for joining me on the show. And great to have the opportunity. Thank you very much. Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.